Welcome to lesson 2. So hopefully you got through lessons 0 and 1. Both are important. A couple of recaps on that just to sort of reset the thinking a little bit. Lesson 0 talks about personal thought processes and behavior. And as someone quoted, and I mentioned this in lesson 1, that 80% of personal financial success is about mindsets and behaviors. 20% is about knowledge. I'll probably keep restating that on each of these lessons because it's so critical. Lesson 1 was important because it introduced the concept of time value of money and the power of compounding, both of which are critical to understand financial decisions and to make right choices. Can't understate how important those two things are, especially the power of compounding and its relationship to time. So I'll keep saying that, and we'll keep coming back to that. So this lesson is going to talk about markets and asset classes. It's going to just do it this is a massively complex topic, which I'm going to simplify to a pretty basic level. So it's not intended to leave you with a comprehensive understanding of any of this. It's more about, again, generating some curiosity and hopefully motivating you to learn a bit more and pay attention to things in a potentially different way going forward. So start off with the definition of what's an asset. Essentially, it's something that you own that has value. Actually, you might not even have to own it. You might just have to control it and be a beneficiary of it. So maybe even ownership is too tight a definition. For example, you could have a lease on a building, which you don't own the building, but you own the lease, and the lease itself is an asset. Anyway, we'll talk more about that. Assets can go up or down in value. They can appreciate or they can depreciate. They can be depleted. That means they can be used up. For example, an asset could be an oil field. Eventually, there's no oil left in the oil field. It's become depleted. Assets can generate income or they can not generate income. Some stocks pay dividends, others don't. The idea being that the appreciation in the asset is more beneficial than paying income. And, buyers of assets have choices of what to spend their money on. It can be liquid or illiquid. This is an important concept. A liquid asset is something that you can sell very readily. You can convert it into cash quickly. A stock would be an example of a liquid asset. A house would not be. It takes a long time to sell a house. It takes seconds to sell a stock. A bag of cash is a liquid asset. A bar of gold is not. It's a bit more liquid than a house, but it's not liquid because in most cases you can't walk into the grocery store and buy a bag of dog food with a bar of gold. Assets can be tangible or intangible. Intangible assets would be things like goodwill on a business, the value of a brand. So something that's not like a thing that you can get your hands around and specifically define. Versus a tangible asset would be, the bar of gold or the house or the oil field, or inventory in a weed shop or something of that nature. Assets can be current or non-current. That's an accounting term. It really means current. Really means in the current accounting period. So if you've got an asset like on your business, again, cash in the bank is a current asset. Where a non-current asset would be something that had value that was that was downstream in the business. I kind of think of a good example of one off the top of my head, but it kind of doesn't matter because from the personal finance perspective, everybody's basically concerned about current assets. Here's a list of examples, and I've tried to enumerate some of the characteristics of each of these classes of asset. Some of them I've already mentioned: a home, a car. Yeah, a car is an asset. It's an asset that depreciates very quickly. It's not liquid. You can't spend it. It generally reduces in value the instant you buy it. It's kind of like a depleting asset in some ways, in that it'll wear out over time. And in most cases, it becomes a bit of a liability because you got to spend money on it to keep it going. An insurance policy is an asset. Again, that's probably a good example of a non-current one. It doesn't generate any income. It's not particularly useful unless you need it, like when you crash a car or you die or something like that. An option contract is an asset. That's an interesting investment structure that we'll talk about at some point in the future. And stocks and bonds and things of that nature, mutual funds, exchange traded funds, are all classes of asset. Let's look a little bit more at stocks and bonds. However, first we've got to talk about what a corporation is, because both stocks and bonds are derivatives of corporations. Corporation is a legal entity. What is a legal entity? A legal entity is a thing that is existence of which is recognized in law. So, you know, when a person is born, that person gets a birth certificate, gets registered that they exist. At some point in their life, they get a SIN number. They become liable for paying taxes. They become subject to the rule of law. You know, they legally exist. They have rights and they have obligations. A corporation is another version of that. It is brought into existence by becoming a registered corporation. It gets a number. The government know it exists. It has to follow laws. It can be sued. It has to file taxes. It can sue other people. It's kind of like almost like a citizen in some ways. It has rights and obligations. It has to follow laws, and it legally exists. It pays taxes. So when a corporation makes a profit, the corporation becomes liable for taxes. Like an individual, when an individual is employed, the individual gets paid, they become liable for taxes. Corporations can cease to exist. You can deregister them. You can cancel them. They can go away. It can be privately owned or it can be publicly owned. Publicly owned corporation is one in which the stocks are traded on the stock market. Therefore, it can have many owners. It can have one owner or it can have many owners. It can own other corporations itself. It can be owned by other corporations. It has many stakeholders: employees, shareholders, customers, suppliers, local state governments, people who interface and interact with the corporation are stakeholders. Its purpose is, generally speaking, but not exclusively, to generate value for its shareholders by providing value to its customers and other stakeholders. There are some exceptions to this. For example, the charitable organization isn't necessarily there to generate value for shareholders. It's there to generate value for its clients and the people it serves, which are essentially its customers, but without the profit mandate. And there can be many different forms of corporation. Their structures and their performance are often complex, hard to understand for outsiders and insiders. And there's an art to studying the what is it that actually makes a business tick. What Warren Buffett is an expert in this. This is how Berkshire Hathaway as a corporation is grown from nothing to many, many billions of dollars, because Buffett's style of investment is to thoroughly understand the business, and you won't buy into a business unless he thoroughly understands it. And this is something else we'll talk about more of. What's a stock or a share? The same thing. They are the means by which companies distribute their ownership, if you like. So when a corporation is formed, it issues shares. The analogy I've drawn here is that if you imagine the corporation as a pie, then the share is a slice of that pie. How big the slice of the pie is and how many slices are indeed cut is driven by the corporation and how it decides to structure its share ownership. But notwithstanding, one stock is one fractional share of the value of a corporation. When a corporation incorporates, it will issue shares either to represent the share of ownership. If it's a private corporation, like say me and Eileen had a company and we each had 50% of the shares, we each have 50% ownership, we would get to vote on how the corporation made decisions. That's one form of share, privately held shares. Again, more important to the investment conversation is the idea of shares that are issued by a corporation that goes public, means itself traded on the stock market. When a corporation does this, what it effectively says to the world is, okay, we're going to issue shares. Ibbotson Corp is going to represent itself with 1,000 shares. we're going to trade them on the stock market, and we're going to set the price at X. The idea is that people will buy those shares with the hope that they're going to increase in value in the future. They'll give the corporation money. The corporation will use that to invest in itself, grow the business. That's called an initial public offering, an IPO. After the IPO is complete and the shares are issued and bought, then individuals who own the shares can trade them like any other commodity in a market. In this case, it's on the stock market. So I can go at an initial public offer and buy a share of, Joe Blow Corporation. I own that share. Okay, Joe Blow got my money to invest in the business. Now I own Joe Blow's share, and I can go sell it to somebody else. When I sell it to somebody else, I get the money, not the corporation. The only time the corporation gets the money from the share is when it issues new shares. After that, the shares are traded like articles, like of clothing, like cars, like any other commodity you might buy and sell. Ownership of a stock conveys certain privileges. You get to vote on certain corporate matters. You get to receive dividends in the case where the corporation pays dividends, and not all corporations do. Generally speaking, in the early life cycle of a corporation, they will not pay dividends. Any profits that they generate, if indeed they generate profits, will get reinvested in the business to grow it. And eventually when the corporation matures and it's generating steady cash, and it's got enough cash to fund its operations and have some left over called profits, it will then issue dividends to the shareholders. Usually what happens in the maturity of an organization is early in the life cycle, they don't pay dividends. A lot of the growth corporations you'll see don't pay dividends because they're trying like hell to reinvest in the business and grow it. But as a corporation matures and it sort of starts to get significant market share and its growth starts to plateau, at that point, corporations would start to pay dividends to their shareholders. You have the right to transfer the stock. I talked about that. You can buy and sell. There are sometimes some restrictions on that for people who are called insiders. If you're an insider and you have specific knowledge of something that's going on in a corporation that would have a potential impact on the value of the stock, then you are not allowed to trade in that stock. That's called insider trading, and it's illegal, and you can go to jail for it. The stock's price and value. So price is what it is. If you look on the web, you go to one of the stock exchange websites or company websites where they have investor information, it'll tell you what today's value of the stock is. Sorry, price of the stock. Value is different. Value is an inherent property, whereas price is determined by the market. What does that mean? Well, I might have a car that I just bought for $50,000. Yeah, to me that car has a value of $50,000. But if I go try to sell it, I'm not going to get $50,000 for it. I might get 40 if I'm lucky. The market determines what the price is. The underlying value is inherent. There are really two ways. There's probably more than two, but there's two that sort of matter. Two ways to establish the price/value of the stock. One is you look at the market. We just mentioned that. Another way is you can calculate the present value of all future cash flows associated with that stock. Remember the present value conversation? Well, imagine you apply that to a single stock in a company. If that stock was likely to pay out over your lifetime a certain stream of cash flows every year, you're going to get dividends, or maybe you don't get dividends for the first 5 years, then you get dividends after that. Notwithstanding, you calculate the present value of those future cash flows, those future anticipated cash flows, because they're not guaranteed. And that will give you the underlying value of the stock using the present value discounted cash flow calculation. That's an important phrase to lock in your mind, a discounted cash flow model. We'll come back to that when we get a little bit more advanced in these discussions. There can be different classes of stock. I've just listed two here: preferred shares and ordinary shares. Usually when a company issues shares, it's trying to appeal to certain investors in different ways. If I'm a high net worth individual and some company approaches me and says, "Yeah, you're interested in investing in my company," I might have conditions that I wish to apply. I might want to say, well, you know, I'll invest assuming I get certain benefits associated with my investment. I might demand a dividend. I might demand certain voting rights, and these will be written into the shareholder agreement, and they'll probably will be called preferred shares. Then there are ordinary shares, which are not subject to the same level of, if you like, finesse in defining the shareholder right. You just go buy and sell them on the market. In some cases, by the way, you can buy preferred shares, but generally speaking, you buy ordinary shares, and the ordinary shares are issued subject to the rules of the market and the rules of the corporation, and you buy them and you accept the underlying conditions that come with them. We talked about dividends again. The dividend is an important concept. It's cash that the company chooses to distribute to shareholders when it sees fit. Here is an important distinction that we'll probably emphasize a little bit here. The corporation can decide whether or not to issue a dividend, how big the dividend might be, when it would get issued. That means it can be zero. That means it can be $2 one year and $5 the next year and $1 the year after. However, the market does have opinions on things like that. So once corporations start to distribute dividends, it's very hard for them to change that behavior without getting punished by the stock market. So for example, if I own a stock that's paying $3 a year dividend, and then I see in the news that it's only going to pay $1, then that sends up red flags. It tells me that, wait a sec, there's something going wrong in the performance of this business. Therefore, dividend payouts are managed very closely. They are used in the market to reflect value and therefore price. And so corporations are very sensitive to how they deal with dividend payments and behavior. In addition to issuing stocks, corporations can buy and sell their own stocks, and they can buy and sell stocks of other corporations. So sometimes you'll find a company that, and there are many examples of this, where companies will invest in other companies. They'll hold, instead of holding cash in the bank, which doesn't serve much purpose, they will invest it in certain ways. And in extreme cases, corporations will seek to buy the majority of the outstanding shares of a corporation in order to control that corporation, potentially with a view to taking over it completely. Personally, the corporation is under no legal obligation to the shareholder regarding the price of the share, nor is it under a legal obligation to pay dividends. That means in cases where companies fail, the value of a share can go to zero. So you could buy a share for $100. 3 years later, the company's failed and the share's worth nothing. Generally speaking, the shareholders have no recourse for that, unless the shareholders believe that the company management has misrepresented the business's financial status, i.e. they've lied to the market. Companies do this. Or if they believe that management has mismanaged the business, resulting in financial harm to the shareholders. There are cases where there have been class action lawsuits where numbers of shareholders got together and sued companies. This happened to Nortel after Nortel went bust and did significant harm to pension funds in Canada. There was a class action lawsuit where a bunch of shareholders got together and chased after the residuals of the Nortel corporation and some of the executives. By the way, directors of corporations can be held personally liable if indeed they have mismanaged the business or allowed mismanagement to happen. But usually as a shareholder, you're taking a risk that you're buying a piece of the company, and you got to assume you have no recourse on the corporation if that company fails and if the share goes to zero value. That's a stock. What's a bond? So I thought about how companies issue shares to raise capital to invest in the business. That's one way of doing it. And in doing so, the company gives up share ownership. So again, if I have my private company and I think, well, you know what, I need to raise a few $1 million to invest in some new invention or some new piece of machinery or something, I'm going to give up some of my ownership of the business. So maybe I'll sell 10% of the ownership. So I'll keep 90%, I'll sell 10%. Or maybe I got to sell 50%, or maybe I got to sell 90% and I only keep 10. That has an effect on the ownership of the structure of the company, how the company can be controlled. It also has what's called a dilution effect on the shares of the business. So what might that mean, for example? So if a company is divided into 10,000 shares and they're each worth $1 each, so the company's worth $10,000, but the company will raise $1,000 more shares. So it could say, well, we're going to issue more shares of this corporation from what we've previously held. So to my 10%, I'm now going to put an extra few on the market and raise a bit more money. The impact of that is that my ownership is diluted, but also everybody else's ownership is diluted a little bit. So all the other shareholders who are out there, they see a reduction in the value of their share because more shares have now been issued. The pie has been sliced into smaller pieces. So instead of doing that, companies can also raise finance by borrowing money. They can go to a bank and they can borrow money, or they can sell bonds. Here's how a bond works. A bond is essentially a loan. It's a loan contract. So if I'm a company and I want to raise some capital, I want to raise $10,000, I could sell a bond for $10,000. So I could say, bond, you give me $10,000. I promise I will pay you 10% interest on that $10,000 every year for 5 years, after which I'll give you $10,000 back. So it's like a contract. All kinds of different entities can issue bonds. Governments can issue bonds, corporations can issue bonds, charities can issue bonds, even individuals could issue bonds and sell private debt to friends and colleagues and family members and things. And essentially the object that is getting traded then is a debt obligation. It's a contract. I will sell you this contract for $10,000. My promise is you get your $10,000 back in 5 years, plus you get interest in the meantime. The $10,000 is what's called the par value of the bond. It is the value at which the contract is agreed when the bond is sold. Is the interest rate that whatever the interval payment agreed is, and it will have a maturity date, the date at which I must repay you the money and close the contract off. Interestingly, while the bond is a debt obligation and it's a contract, it legally obligates the corporation to pay the interest, unlike a dividend over which the corporation has choice. The corporation does not have the choice to pay a debt obligation. However, if it fails to do so, it's then in breach, which would give the bondholder a direct claim against the corporation. So imagine a corporation fails and it has outstanding shares and it has outstanding debts. Then the shareholders and the debt holders go to court. The court deals with the claimants against the corporation in order of priority. The first priority is the government and any taxes that are due. The second priority is employees and any wages and things that are due. Thirdly is credit holders, so people who are owed money by the corporation, which would include bondholders. And then lastly are shareholders, so they come to the bottom of the pile. So bonds do present a legal claim position against a corporation and are therefore usually viewed as being slightly lower risk than stocks. How much is a bond? If you want to go buy one now, well, when you go to buy a bond or a bond fund on the market, as opposed to directly with a corporation when it issues a bond, you're not paying the par value of the bond. You're paying the market price of the bond. And how does that work then? Well, much like a stock where the market price is supposed to represent the discounted cash flow value of that asset based on the cash payments it's going to issue in the future. Similarly, a bond price is the present value of the future payments, which would include the terminal payment on the bond. And that future cash flow is discounted by, typically in this case, the risk-free rate of return, which would be comparing it against government issued certificates or the risk-free assets. What that does, that has an effect on the present value of those future cash flows and therefore the price of the bond, and therefore it's highly likely that the bond price is not the same as the par value. It's the market value of the bond. Market values of bonds can go up and down just the same as stocks can go up and down. They tend to be less volatile, but they can still change. How might that play out, for example? So if let's say prevailing interest rates are 5%, and I can go buy a bond that pays 6% interest. So risk-free overnight rate of return is 5%. That's kind of like the overnight rate of the bank. So I can put my money in the bank and I can get 5% and I can withdraw it the next day if I want. Versus I can go buy the bond that's paying 6%. And then let's say prevailing interest rates go up and they're now 7%. Well, the value of that bond that I just bought now got less because the discount factor, the equivalent risk-free return in the bank is now 7% instead of 5%. And it's more than the 6% that my bond is paying me. Therefore, if I'm an investor and I've got that, I now was contemplating buying that bond, I'm going to be less motivated to buy it because I can get a better return by putting my money in a different vehicle, i.e. the bank, and it to pay higher interest and it'll be more flexible. So that bond is a less attractive investment. Therefore, it's gone down in value, which would be reflected in the discounted cash flow of its future cash returns. So bonds are not risk-free. They can go up and down in value. There's a reciprocal relationship between interest rates and bond pricing or bond yields. The yield is the ratio of what the bond pays out versus its price. What the bond pays out is typically constant, and therefore, if the yield increases, that means the price has gone down. So when interest rates rise, bond prices will fall. We've seen that over the last few years. In fact, I should have pulled up an example of some bond funds that I owned a few years ago that are worth about the market value of them now. Market price today is about half of what it was a few years ago. This is just a little example of a bond. This is, again, an imaginary 5-year bond with a $1,000 par value and a 10% coupon rate. So every year you get $100 worth of interest. And then at the end of the period, you get your money back. That's a bond. What's an ETF? Okay, so an ETF is, it's a legal entity. So it's essentially a corporation which holds securities, i.e. stocks or bonds or other assets issued by publicly traded corporations on the stock and bond markets. So an ETF could be, let's say it's an oil sector ETF. The ETF, the exchange traded fund, would be a corporation that would own many shares of many different corporations in the oil and gas sector. And it would call itself, I mean, I own one of them, it's called a equally balanced or balanced oil and gas fund. In fact, there it is down there. Its ticker is ZEO. It's down there in the left-hand corner there. The secret of an ETF is kind of hidden in the name, exchange traded fund. It means it behaves just like a stock. You can buy and sell it on the markets, just like a stock. It's a highly liquid asset. You can convert it from ownership into cash in seconds by logging onto your account and selling it, or you can buy it in seconds. Unlike a mutual fund, which is structured similarly, it's a collection of stocks or bonds from other corporations. And for reasons I don't fully understand, mutual funds settle their price at the end of the day rather than being adjusted throughout the day, and therefore they take a few days for a sale to process. Why does that matter? Well, that means if you see the value of things collapsing and you try to dump your mutual fund, it takes longer to get out of the market than it does with an ETF. Similarly, if you want to get into the market quickly for whatever reason, mutual funds can take a few days to process. I don't own any mutual funds. I own a lot of ETFs. In fact, almost all my investments are in ETFs. Mutual funds tend to be more expensive to manage and they attract a higher what's called a management expense ratio. So more of the value of the assets in the fund goes to pay the fund managers than is the case with an ETF. ETFs may or may not pay dividends called distributions. I can't think of a one that I own that does not pay a distribution, but I'm sure you can find one if you wanted to. The distribution from an ETF will come in typically three forms. It'll come in actual dividends paid by the stocks that the ETF owns. It would come in the form of capital appreciation of the assets within the ETF. So the ETF owns a bunch of stocks, they go up in value, the ETF sells some of those stocks, it realizes a capital gain, and it would distribute part of that capital gain to unit holders of the ETF. Some ETFs will also pay paid in capital back. So paid in capital is a notion where a shareholder puts $1 into a business, and then later on it gets the dollar back. That's not income and it's not capital gain, it's a return of capital. It was money that was originally invested and it's returned to the investor in the same way. So it's not a taxable event. So you get this three class of distributions from ETFs to me. Well, actually four. You get income, dividend payments, capital gains, and return of capital. Income is what is derived from interest. So if you have an ETF that contains a lot of bonds and it pays interest, that interest shows up as income. What's the difference? The difference is in how it's taxed. In Canada, there is preferential tax treatment for both what's called eligible dividends and for capital gains. They are both taxed favorably when compared with income. The reason for that, by the way, is to motivate investment in corporations, is to give investors the incentive to take a bit of risk and own parts of Canadian corporations. ETFs are liquid in that they can be bought and sold in real time. I mentioned mutual funds as a comparison point there. And they take a charge. The fund managers will take the cost of running the fund from the assets in the fund to pay for its operations and its tax returns and the analysis that the fund managers have to do. And typically they're in fractions of a percentage point for ETFs. Of the ones I own, I don't think I pay more than like 0.7%, and that would be expensive. Some of them it's 0.1%. Mutual funds tend to be higher. In the past, I have owned mutual funds that charge 3%. And at 3%, almost all the gains you're going to get from the investments in the fund are paying the fund managers and not the investor. Here are some examples. These are all ones that I either own or have owned. First two I still own. The last one I used to own. ZSP is a Bank of Montreal ETF, which is representative of the Standard & Poor's 500 index. So it essentially represents the US stock market. The graph in the corner here is the comparison point of these three ETFs. This nicely growing line is the one you saw earlier on in this course. That's ZSP. You'll see how it's grown steadily over the years from 2013 to today, and you'll see the glitches when the market has done unfavorable things. And buried down there close to the bottom is ZEO, which is the oil and gas fund that I still own, and ZHY, which was the bond fund that I owned, which kind of has halved in value recently. What do you take away from that? Well, if you're looking for long-term capital growth, ZSP has been by far and away the better investment choice over the last decade. Now, that doesn't mean either two are bad, because here's the rub. ZSP is the S&P 500. It pays a distribution of about 1.3%, which is not a lot. I mean, that means if you have $1 million invested, you're getting $13,000 a year worth of income from $1 million, which is not a lot. Therefore, that fund is more about long-term capital growth than generating income. ZEO, the oil and gas fund, on the other hand, pays, I think, about 5% dividend. It does have some upside to grow in value. That's something I'm still holding that fund. I'm kind of keen on it because I think oil and gas has got a long way to go, despite all the talk about getting rid of it in the media. There's no sign of that happening anytime soon. So I think there's some upside in that fund, and it pays a reasonable healthy dividend of about 5%, which is, again, it's a tax advantageous dividend because it's paid on Canadian corporations. Then you got ZHY, sorry, the US bond fund. That's paying, I think, about 7% return. So if you buy that bond today, it's paying about 7%. Now, interestingly, that bond price has collapsed with the high interest rates in the market. So part of my thinking at the minute is, do I buy back into that fund in anticipation that when interest rates drop in probably 24, 25, that I'll see some appreciation in the value of that asset there. I haven't figured that out yet. I'm kind of thinking about it. But just to give you an example of these three different funds, how they're performing, a little bit of a talk there about why you might choose one versus the other. Lots more discussion to be had on that. Okay, so that's three types of assets: stocks, bonds, and ETFs, which themselves are collections of other assets. By the way, you can even have ETFs that own real estate. So you can have an ETF that owns a thing called a real estate investment trust, which owns commercial property, residential property, some combination thereof, and you can get dividend distributions from that, which are derived from the rent. And you can get capital gains or capital losses, by the way, from the appreciation or depreciation of the assets in the fund. All these things get traded on a thing called the stock market. So what the heck is a stock market? Well, in its simplest term, it's a large public auction that happens in real time during trading hours. So the participants in the market are buyers and sellers and brokers. You got brokers who facilitate trades between buyers and sellers. And the market price of a stock or an ETF or a bond, when you look at it on the market, is the instantaneous price that is being bid by players in this market. And I say bid because it's a bid. As a seller, you do not have to accept the bid price. If you study a stock and look at trades on any given day, you'll see bid and ask. Bid is what buyers are bidding. Ask is what sellers are asking for. Usually these are like a cent or two apart. So in real time, the quote that you see on the web will represent the market's appreciation of the price of that asset. If information changes throughout the day that results in a change in investor sentiment, you'll see the price change in real time. So when you go to buy or sell a stock and you trade it at the market price, you'll see, okay, I want to buy 100 of those stocks at market price, and it's $100 a share, so you're doing a $10,000 buy. You'll hit the buy button on your brokerage webpage. The brokerage will go off to the market. It'll say, anybody want to sell me 100 of those shares at $100 each? And depending on what's happened in the market, between the time you hit that buy button, and your trade gets filled is the process by which the order is closed, the price can change. And in some cases, it can change really quickly to the point where you wish you'd never hit the buy button or the sell button if you're selling stocks. So there's more to get into in the future on that, about how to set up buys and sells to potentially avoid wild swings in price that can be caused by, particularly in highly volatile market conditions. The stock market is assumed by some to be what's called an efficient market. There's a thing called the efficient market theory that says everything that is known about an asset or stock is accessible by all shareholders, all potential stakeholders, and buyers and sellers in the market at the same time. It implies that if some new facet of information occurs, like all of a sudden, like halfway through the day, somebody invades Japan, then that news becomes instantly available to everybody in the market and consequently informs all stakeholders in the market to the same degree at the same time, so they all make rational decisions. It's a very complex topic. It has huge implications. My personal belief is the market is somewhat efficient. It's not ideally efficient. That means that certain players can be advantaged in the market relative to others, which of course is the case. If you have large buyers or large sellers in the market, they can change the value of a stock just by buying and selling large quantities of it. Some stakeholders can have much more efficient access to information than others. Generally speaking, guys like us have no clue what's going on until it's already happened. We're not market makers. We respond to the market. Therefore, this notion of efficiency, while it has some academic interest, to me, the key takeaway on that is you don't know what's going on until it's already happened. Therefore, you can't guess with any accuracy whatsoever about what's going to happen on any given day in the market. That's an important principle that we'll come back to. When you buy and sell on the market, your brokerage, whether in my case it's BMO InvestorLine or it's TD or it's whoever you use as a brokerage, they'll organize the trade for you. They'll keep track of your trade. They'll keep track of your capital gains for tax purposes. They'll get the dividends off the share of the company that issues the dividends. They'll put them in your account for you. They'll manage all this stuff for you, and they usually charge you a fee for that, which is generally in the range of $10 to $15 per trade. So if you're buying and selling in the market, you're spending money on your brokerage. If you're not, you're not. Kind of that simple. Yeah, when you buy a stock on the stock market, you're buying it off other shareholders, not the company that issued the stock, unless it's an initial public offering. And likewise, when you sell on the market, you're selling to unknown buyers via their brokerage. You don't know who buys your stock, and you don't know who you buy it off. It's a giant public auction. So what do we take away from this? Assets are things that you own that have value. They have different characteristics in terms of how they pay or not. They have different characteristics in terms of whether they have a tendency to go up or down in price over time, their degree of liquidity, and their price sensitivity to macroeconomic forces. The latter point being the key to how the stock market tends to wobble up and down, and also, impinging on this concept of market efficiency. If something happens in the world, how quick is it that it has an impact on the market? Again, generally speaking, and this is important, as a retail investor, by the time something happens that affects the stock price, it's already affected it. So you as a retail investor have very little ability to either respond to that rationally or influence it in terms of your own decisions, which is why day trading is particularly risky, because you're not acting in an informed way. You're guessing what might happen next based on what happened 5 minutes ago. Understanding the principles that affect the behavior of the market in the long term is key to getting your head around market risk. And again, we'll talk about risk in another session on this course. Just a reminder that stocks are fractional ownership stakes in entities that can go to zero in value, and bonds are debt obligations issued by entities and are traded on the market like stocks. The quotes guarantee to pay out a certain level of interest, but nothing's guaranteed because businesses can fail. In the case of bonds, you can try to sue a company if you so wish to get your money back if they fail. In the case of stocks, you can't. So here endeth lesson 2, and I'll see you again.